Suppose in case of the profit and loss account, let's take an example. I'll explain through the example how it would be changes. Here a simple profit and loss account is like this. Suppose purchase expenses, then the amount of office miscellaneous expenses, office expense, miscellaneous expenses, depreciation. All right, so these are the transactions which are actually recorded on the debit side. We have some sales also. The sales would be recorded on the credit side. Then net profit, it's around 60,000 rupees of profit. This is an example. Now let's see how it would be actually find out. The net profit of the business is 60,000, but the cash is not exactly determined what exactly you received amount of a net profit. It does not mean that whatever the net profit you have in the profit and loss account, it is your cash. No, it cannot be considered. The amount of net profit is equal to your amount of cash. Why? Because there is a one transaction which is purely related to a non-cash items. That means the depreciation which were charged in the profit and loss account, it's a non-cash transactions which is necessary to record in the profit and loss account to identify your profitability. But this is a non-cash items because of at the time of charging the depreciation, we are not supposed to pay any amount to the vendors at the time of charging a depreciation. So this is a non-cash item. So 15,000 rupees debited, it is not affected to the cash. Hence, the actual cash inflow is 60,000 rupees. It's your net profit plus what the depreciation we charged 15,000 rupees added into that. So the 75,000 rupees, it is your net cash inflow. Why? Because of the depreciation was actually not goes out from the business. The amount and cash is not goes out from the business, and that's why we added 15,000 rupees in your net profit. Hence, the actual cash is now 75,000. If all other expenses, we assume that if all other expenses are paid in cash, whether it is a part of expenses, office expenses and the miscellaneous expenses, all expenditures are paid in cash, and we assume whatever the sales are written in this profit and loss account, that is also cash. That means the 1,50,000 rupees is cash, and all other expenses including purchase, that 30,000 purchase expenses, 20,000, 10,000 office expenses and miscellaneous expenses is 5,000. The total of this is comes to 65,000 rupees. So all expenses 65,000 rupees and sales is 1,55,000 rupees would be considered. So 150 minus 65,000, it comes to 85,000 rupees, and that 85,000 rupees, it's part of the amount of the changes in, just a moment, 30, 50, 60, 65,000. The 65,000 rupees in case of, here the maybe profitability is something we need to identify. 150 is here, 30, 50, 60, 65 and 80. That comes to 70,000. Sorry, this net profit is 70,000. So 70,000 rupees net profit, 15,000 rupees would be here. So it's changed here. 85,000 rupees, it's net cash inflow. Now we are actually find out in another method that we assume the sales is net cash sales. All these expenses are also net cash. So 30, 50, 60 and 65. So 1,50,000 minus 65, the difference is 85,000, which is tallied here the net cash inflow. In short, the net cash inflow in this business or in operational activity is the amount of 85,000 related to operational activity. Here, as per the above calculation, it is clearly observed that in order to determine the net cash inflow due to the operations, that non-cash items debited must be added back to the profit. The depreciation is a non-cash item, and that's why we added back into the profit to identify your net cash inflow. In addition to that, any intangible assets or fictitious assets are written off, which are also a non-cash items, and if it is debited in profit and loss account, also to be added back in your profitability to find out net cash inflow of the business. Some of such items are goodwill write-off, patent write-off, trademarks write-off, any preliminary expenses and undertaking commissions, and amount of fictitious assets has been written off during the year would be added back into profit. So this is what all about the operational profit of the business. This is one of the source to identify net cash inflow and net cash outflow. The second sources of cash inflow and outflow is that any changes occurred in current assets and current liabilities. So the changes identified in current assets and current liabilities also affected to cash inflow and outflow. So we will find out how the current changes of current assets and current liabilities also affected to cash inflow and outflow. Changes in working capital. Ultimately, both the items are affected to the working capital. So changes in working capital is also a part of cash flow statement. And under that, the cash flow is affected due to the changes in current assets. Let's see an example. Supposing the net profit is rupees 1 lakh. Suppose the net profit is rupees 1,50,000 and the debtors in the beginning of the year is rupees 50,000. So at beginning of the year, the debtors is rupees 50,000 and at end it is rupees 70,000. This is a debtors value. Net profit is rupees 1,50,000. Amount of debtors in the beginning it's a 50,000 and the amount of the debtors at the end is rupees 70,000. There is a change in current assets. There is a change in the current assets, see, in the beginning and at the end of the year. The closing balance shows that the total sales made during the year is rupees 70,000. How much sales you made it during the year, and that is credit sales. That is credit sales. During the year you made the sales of rupees 70,000 and has yet to be received. That means the amount has not been received till date. But so the cash received, the whatever the amount of the debtors which you shows in the beginning of the year, that we assume that the credit sales were done in the last year and amount received during the year. Amount received during the year. Now, how it would be changed? How it would be affected? The closing balance shows that the total sales made during the year is rupees 70,000, which will be received the amount in the coming days. That means it has not been received yet. And the another important part is the amount of rupees 50,000 of the debtors which shows in the beginning. We assume that the sales which was made last year or maybe the last preceding year, the credit sales of this amount has been already received. Now we find out the exact cash inflow from this transaction. See, the net profit is 1,50,000. The amount which we received during the year is the last year credit sales. That we assume that the last year credit sales amount received during the year, so it's inflow. So cash inflow, we are not finding it, we just assume that it's cash inflow during the year is rupees 50,000. So it comes to 2 lakh rupees. And the amount of credit sales made during the year 70,000 rupees, which is not received yet. That means the amount may be received in the coming days. That is cash outflow is rupees 70,000. It means the net cash inflow or net cash is 1,30,000 rupees out of this transaction. So net cash inflow out of this transaction is 1,30,000. It can be stated that the another manner also, like the book debts which are actually shows a 50,000 in the beginning have increased to rupees 70,000 at the end of the year. So book debts are there. It wasn't 50,000 in the beginning of the year, and at the end of the year it's reached to 70,000 rupees. The difference amount is rupees 20,000. That means the book debt has been increased to rupees 70,000. That shows the reducing the cash inflow of rupees 20,000. So here the difference between these two is 20,000 rupees. Beginning is 50, at the end is 70, the difference is 20. Because of the increase in your cash inflow, it shows the net amount of consideration cash inflow of rupees 20,000. From that we can say that cash flow decreases due to increase in current assets. Here the cash flow decreases. How much net profit is there? 1,50,000. At the end of both these transactions, what was the cash inflow? It's 1,30,000. So it means from the beginning of net profit, at the end of cash inflow, your amount of current assets is consumed, and that's why the cash flow is decreases due to increase in current assets. The beginning of the current year it was 50,000. At the end of the year, your current assets is increased. But because of the current assets is increased, your net cash inflow was decreases. In case of reverse, cash inflow is increases due to decreases in the current assets. Suppose we want to change it. At the beginning is 70,000 and at the end is 50,000, automatically would be changed. What was the beginning period? It is 70,000. Correct? So beginning period cash inflow, what we assume? It's a last year sale. Cash comes during the year, so added 70,000 and it comes to 2,20,000. Total would be 220. What is the during the current year sales, credit sales? It's 50,000. So that is cash outflow. 50,000 rupees deducted from it. What would be the answer? The answer is 1,70,000. What was your profit in the before these transactions? 150. And now what is your profit after this transaction? 170. So the changes is what? It shows the cash flow increase. But what was the change in the assets? The change in the assets is assets decreases. Your current assets is decreased from 70,000 to 50,000. It's reflected here, the cash flow is increases. That is, there is an inverse positions or inverse proportion between the current assets and cash flow. Here we move to the another example, that is the change in any current liabilities also affected to the cash flow. And the same way we can consider in case of any creditor's value which we have a some amount and the net profit is different, then the amount of creditors in the beginning of the year and at the end of the year would be reflected for in the profit were increasing and decreasing. So now the changes, how it would be affected of the net profit in case of the creditors are changed. Here suppose see the another examples for the changes in the current liabilities. In case of the current liabilities like creditors, suppose at the beginning we have 10,000 rupees of creditors and at the end we have 30,000 rupees of creditors and the net profit is rupees 1 lakh. We'll see the changes of these transactions in the net profit and identified whether what amount of cash inflow and outflow is happened. Let's see, the net profit is rupees 1 lakh. The beginning of the creditors is rupees 10,000. It means the amount of credit purchase were done in the last year, that shows the beginning of the creditors. We assume that the beginning of the creditors were paid during the year. That is beginning creditors rupees 10,000. So its cash goes out from the business, it's reduce your inflow, and at the end of the year we were actually having a 30,000 rupees of credit purchase which yet to be paid. That means it is not paid yet. In that sense, it actually shows a cash inflow of rupees 30,000 due to a credit purchase, it comes to added into your balance of profit, and then closing balance of your net profit is 1,20,000. Now see, net profit before this transactions were on 1 lakh rupees, and after this transaction the net profit is net cash flow is 1,20,000. That means it's increase. Your net cash flow is increasing. Now see the creditors. The beginning of the creditors were 10,000, end of the creditors is 30,000. It means the current liability is also increasing. So from out of it, it is actually derived that the amount of net cash flow is increasing due to increasing of a current liability. The formula has been designed out of this transaction is net cash flow increases due to increase in current liabilities, and cash flow decreases due to decreasing in the current liabilities. So this is a change of a cash inflow and outflow. Now I'm taking one example to identify the changes of net cash inflow and outflow from the two different activities. One is an operational profit, other one is the changes of current assets and current liabilities. Let's take an example. For that, I have already some informations regarding the particular example, where the profit is given, stock which is current assets, debtors it's also a current assets, creditors it's current liability, bills payable it is also a current liability, and the depreciation, that's a non-cash items during the year, are informations given. Out of these informations we need to identify the net cash inflow and outflow of the business. So we will prepare the statement of net cash inflow and outflow of the business. Let's see. Let's begin with the first item. Amount of net profit is given. So start with that. Net profit during the year is rupees 50,000. Now we will take it first informations which are non-cash items. Here only one item is given regarding the non-cash item, that is depreciation. So as we discussed earlier that any non-cash items are always added back into the profit. So that's why the depreciation is added back into the profit, that is 10,000 rupees. So after the operational activity, there is only one operational activity, the net cash inflow is 60,000 rupees. Now we will find out, add and deducted the changes in working capital. Let's begin with the addition. As we already discussed in the previous part, that whatever the amount of changes in assets and liabilities, we identified on the basis of a certain formula which are the items to be added. Let's see the stock. Here the changes in the stock, that the opening stock at the beginning, that is 30,000 rupees, and at the end the stock is rupees 20,000. As I already told you, in case of